Dear viewer, welcome to CA Education BD. Today our topic CA Knowledge Level Assurance Chapter 3 Process of Assurance Planning the Assignment Part 2. I am Mohammad Sohail Rana with you. I hope this video help for your study. CA Education BD is a part of MS Rana Consulting Services. Let's go. Material. seeking to raise finance. Other motivation for director to misstate the figure such as profit target or profit related bonus. Financial statement contain balance with complex financial accounting requirement or a choice of treatment. The auditor must use their professional judgment and all available knowledge to assess inherent risks. If no such information or knowledge is available, then the inherent risk is high. Inherent risk is affected by the nature of the entity. For example, the industry is in and in the regulation of falls under, and also the nature of the strategies in adopted. Control risks. The risks that a material misstatement would not be prevented, detected, or corrected by the accounting and internal control system. Risks that the auditor will not detect a material misstatement in the financial statement. Detection risks. The risk that the auditor procedure will not detect a misstatement that exists in an accounts balance or class of transaction that could be material, either individually or when aggregate with misstatement in other balances or classes. This is the component of audit risks that the auditor have a degree of control over, because if risk is too high to the tolerate, the auditor can carry out more work to reduce the aspect of audit risks, and therefore audit risks as a whole. The auditor will obviously consider how risky a new client is during the acceptance process, and may decide not to go ahead with the relationship. However, they will also consider audit risks for each individual audit and will seek to manage the risks. It is not in the auditor's power to affect inherent or control risks, as their risk is integral to the client. The auditor cannot change the level of those risks. The auditor therefore manages overall audit risks by manipulating detection risks. The only element of audit risks the auditor has control over. This is because the more audit work the auditor carried out, the lower detection risks, because although it can never be entirely eliminated due to the inherent limitation of an audit. Identifying and assessing the risks. BSA 315 say that the auditor shall identify and assess the risks of material misstatement at the financial statement level and the assertion level for class of transaction, account balances, and disclosure. The auditor is required to take the following step. Step 1. Identify risks. Thought out the process of obtaining an understanding of the entire entity and its environment. Step 2. Relate the risks to what can go wrong at the assertion level. Step 3. Consider whether the risks are of a magnitude that could result in a material misstatement. Step 4. Considering the likelihood of the risks causing a material misstatement. significant risks. Some risks may be significant risks which require special audit consideration. BSA 315 set out the following factors which indicate that a risk might be a significant risk. Risks of fraud related to recent significant economic, accounting and other development. The complexity of transaction. It is a significant transaction with a related party. The degree of subjectivity in the financial information. It is an unusual transaction. Routine, non-complex transactions are less likely to give rise to significant risks than unusual transaction or matter of director judgment. This is because unusual transactions are likely to have more management intervention, manual intervention, complex accounting principle or calculation, opportunity for control procedure not to be followed. Thanks for watching. Please subscribe this channel, like and share this video, provide your valuable comment and like our Facebook page. Need your help and support to improve my channel. Next chapter coming soon. I hope you will watch.